The number has leveled off and we're ready to start. So thank you everyone for joining us today on the topic of building ambitious climate plans, investor leadership on decarbonization strategies. My name is Jennifer Story and I'm the Director of Public Affairs at Share. And I've had the distinct pleasure of working with a number of our clients and networked investors on issues and work related to creating climate action plans, assessing climate risk, et cetera. Many of you on the call are university endowments or small to mid-sized pension funds, foundations, et cetera, a range of asset owner size and type. But we think that today's topic will be helpful for all of us to be thinking about the evolution and trajectory of climate planning for institutional investors. As we all know, the challenge today in broad terms, beyond our individual investment decisions, isn't just about managing risk. It's also about mobilizing capital to accelerate the transition to net zero. That is our collective human project, if you will. And investors have to play a critical role in that mobilization. CDPQ, or La Caisse, as it's now known. Their new climate plan represents one of the most ambitious and integrated approaches to by a global asset owner. It combines clear decarbonization targets, obviously, but also strengthened investment criteria and a commitment to financing the solutions that are needed for a low carbon future. So our goal today in the next 45 minutes is to unpack what that plan looks like in concrete terms and to explore how investors of all shapes and sizes can adapt and scale some of their lessons learned and the level of ambition within your own mandates, portfolios, and governance structures. So that being said, I'm very pleased. It's my distinct pleasure to welcome Bertrand Millot from CDPQ, the head of sustainability at CDPQ. Bertrand has been a central architect of their approach to responsible investment and climate strategy and brings expertise in both finance and sustainability, having led CDPQ's first climate strategy and its evolution in today's more expansive plan. Before joining CDPQ, Bertrand has over 2 decades of investment banking and risk management experience. He has brought a strong analytical lens and a clear sense of purpose to the work, and translates big sustainability ambitions into practical investment action. So with that, Bertrand and I have agreed we're going to have a conversation today, and I've got a number of questions for him. So rather than the traditional presentation format, Bertrand will be sharing some slides with us as they arise in the course of the conversation. And for all of you participating, please use the Q&A function to pose your questions to Bertrand. And we will certainly make sure that we have space at the end to get to your questions. So Bertrand, thank you so much for joining us today.
Well, thank you. Thank you, Jennifer, for having me. Hi, everybody.
So as I said in the intro, you've just released your new climate plan with great fanfare and well-deserved aplomb. It has some very impressive targets in it. Can you share with us from the outset some of the major highlights, or what you think are as a lot of people use the term TLDR now, that the Reader's Digest, if you will, version of what the plan encapsulates and how it changed from the previous iteration?
Yeah, so the headline, the TLDR, is $400 billion invested in climate action by 2030. I will come back to what that means exactly, but maybe I should cover a little bit how we got here. I'll just give you I'll share my screen. Can you see my screen now? Yeah? Yes?
Yeah, there it is.
Okay, great. Sorry, I'm not very familiar with Zoom. So this, you recognize, I'm focusing on the curves here. You recognize the curves. There are the various climate curves under different scenarios. And we've added, and to scale, the CDPQ's trajectory, both in footprint, -48% since 2017, and in intensity. We started in 2017 with targets to increase green investments and targets to reduce the footprint of the portfolio. And our latest target was -60% by 2030. And this is, at the time, what was expected to be best practice. If you recall, in 2017, the TCFD came out. It had a two-page annex covering what finance types should be doing. And the emphasis was on decarbonizing the portfolio. So we have, and the result here shows speaks for itself. Just to give you a sense also in terms of what exactly happened in the portfolio, we started with $271 billion in 2017. We had at the time 18 billion in green assets that grew to 58 by 2024, and a carbon intensity that declined by 69% by 2024. Yes. In the meantime, the portfolio had grown by over 60%. So, and what happened, and then in 2021, we also decided, okay, this is great, decarbonizing is great, but we need to make sure that we can actually invest in companies that have decarbonization plans, and it's that yellow little portion there on the graph. And so the idea was we can invest in things that are highly carbon intensive, but for the express purpose of reducing those emissions going forward. So it was hands-on decarbonization, and we counted that effort aside from the overall trajectory. So this is all good, but within that period, the planet's emissions have increased by 6%. And in the end, what we did was, okay, invest in green, do a little decarb, but most of the reduction in footprint has been from asset selection, not decarbonizing the real economy. And that is a problem because, as I say jokingly, if we continue on this path, we can have a net zero portfolio, which is buy gold bars. There's no more emissions in the portfolio. That's why CEO said, when I said that, he said that might have been a good idea for returns, but not with a $500 billion portfolio, and not to decarbonize the planet. And so if we expect to reduce systemic risk linked to climate, reduce physical risk, etc., we need to change tack. And this is what we've been doing with our new strategy. So our new strategy, and I'll go to explain the 400 billion, and then I'll explain the why, is here. Two pillars. Climate action, so that's the overall definition. The first one is to invest in companies that decarbonize, and that's a big change. Before we were focusing on decarbonizing the portfolio. Now we are focusing on investing in companies that have decarbonization plans, they have transition plans. And so it's quite a shift. And the other is to continue to invest in green climate solutions, which include green, but we have broadened the definition using external taxonomies to cover more aspects of it.
Thank you, Bertrand. That's great. So you touched on something that I wanted to probe a little bit deeper with you, because I think a lot of the folks on the call, or I suspect some of the folks on the call, struggle with this question, or maybe even haven't had a chance to really dive into it. But that issue of decarbonizing portfolios really being the name of the game, and when TCFD came out, and that was the project, and still is the project for many of us. But that has a limited impact. And you spoke about intensity targets, being laudable, but not being the whole picture when we still see overall emissions in the economy going up. Um, what is what is our mission as investors to be supporting real economy emissions reduction? So how do you think we need to evolve our thinking around the importance of emissions intensity measures in our work?
Well, I think our mission as investor is to generate returns, and that's very, very, very important. Optimal risk-adjusted returns, and this is why we're doing all what we're doing. But our view is that the questions of climate change are here to stay. They are not a hoax. It's not a joke. It is not woke. All that rhymes. It's interesting. And that climate change is a systemic risk that needs to be dealt with. And the reason we're doing this is to benefit from the opportunities that this challenge presents, investment opportunities in the form of climate solutions, but also ensure that the companies in portfolio, when we talk about decarbonization, we talk also about climate maturity, making sure that they are thinking, okay, how am I going to make new products that people will want to buy in the future, new products with less carbon, and also to future-proof my business against the effect of climate change, which may be physical risk or regulatory risk when the regulatory risk returns, and it's when, not if, because mankind will have to fight climate change, and therefore the political discourse is going to come back to carbon pricing and pushing the agenda. And so what we are trying to do is we want companies to be ready. And the problem, coming back to your question, Jennifer, the problem is if you just carbonize the portfolio, those companies may be low carbon, but they're not ready. And so it does not shield you from climate risk. It doesn't mean that those companies are going to be well equipped to deal with the future. What we want is companies that are climate aware and thinking about how they're going to position themselves in the future, given the challenges that they will face, we all face.
That's great. We're going to come back to that profile of the company that you're talking about and how you find and work with those folks in a second. But I want to ask you first, because you also talked about the heavy investment in climate solutions. A lot of investors are nervous about diving in this way because of assumptions about heightened risk. How has your team dealt with that question of risk? And what lessons might there be for smaller investors who might not have the size of team you have to be thinking about risk differently as they construct their portfolios for a low carbon future?
Yeah, that's a very good question. I think as in a lot of investment opportunities, there are some that are with more risk and some with less risks. We are a pension fund, so we're relatively risk averse. And we've built our climate solutions portfolio, as I said earlier, $58 billion today. It continues to grow on tried and tested solutions, which are largely renewable energy, green real estate, and green mobility, largely rail transport. But those are tried and tested. And actually, we have looked back. We are out of the oil sector as a plan, oil production and refining, but we have looked back and made calculations with our new energy portfolio, which is basically green power and those companies that are decarbonizing, that yellow piece that I talked about earlier. The return on those has been 50% higher than the money we would have made by deploying that in oil over the last 5 years. So, it speaks for itself. It's a sound investment decision. We're not trying to save the planet at the expense of return. We're trying to generate good returns and having a positive impact. And so that is one example. The climate solutions also include nature-based solutions. We have a team that invests in nature, that may be forestry, that may be sustainable agriculture. It is also ecosystem restoration services. We've recently announced a deal in Australia where we are investing in farms that will convert to planting carbon-absorbing species for part of their land, and therefore selling carbon credits to a miner in Australia. Now, all this is tried and tested and generating good returns and perfectly adequate for pension plans. We've also, and it's public information, we did invest in Northvolt. We've invested in a number of other things which are much riskier. Our strategy there has been to put toes in the water to see how warm or cold the water is. As I said, in certain cases, there were piranhas in the water, so we have no more toes. But the point is that allows us to try and test various things. What we also do is portfolio companies that we have in portfolio are trying the various things. And so we're able to see how it goes. There are little labs in there, and then give us comfort to then deploy more money at scale on some of those solutions that have been proven to work in the lab, so to speak. Now, we are big and we have direct investment teams. But if you're not so big and not so lucky, there's funds that can do that for you. And at various, as you know, various levels of risk. Infra funds are less risky. Green tech venture is risky. And depending on your risk appetite, you can invest in these things indirectly. It is more difficult to do so in listed paper.
Thanks. Going back to what you said before about investing in companies, and the profile that you're looking for is not just that they've reduced their emissions, but that they're prepared for a low climate future and prepared for the world around them as we move towards the next 2 decades. Doing that clearly must require a great deal of stewardship on the part of CDPQ to understand what those companies are up to perhaps advocate for different look at things, and to encourage that degree of climate planning that you spoke of. So what shape does that take for your team? What does that look like? And has it, as you have evolved from your first climate plan to now, has that required any retooling internally in order to achieve those external goals?
Yeah, that's a good question. Well, it's certainly required the need to explain the new strategy, and also develop tools to put it in place. But maybe I should come back to that question of decarbonization, which is really the crux of the matter here. You saw the graph earlier. We created 3 levels: committed, aligning, and aligned. We were thinking about that last year when it was the Olympics, and so you might call them bronze, silver, and gold, and the rest need to go to the gym. The point is, on your question on stewardship, we need to push companies to become climate mature. That happens through normal, so to speak, engagement of listed companies, voting, proxy voting, supporting or not shareholder proposals on climate. In private assets, we are fortunate, as I mentioned, to have our own teams, and therefore we engage companies. We're on the board of these companies, and we just push or we ask. In our infrastructure portfolio, for example, we imposed on our companies, they're all private companies, that they produce a TCFD report. And the idea there is not to just create paperwork or drive everybody crazy, The idea is to force those management teams to have a discussion. It's easy to write a report. It's easy to write a story if you have a story to write. But if you don't know what to write, there will be a bit of writer's block, I should say. And so the idea there was to basically trigger a discussion. What does climate mean for us? What are we equipped? What is our governance? What is our strategy? Are we going to develop new business? Is that even relevant in the business we're in? What are we going to do to protect ourselves from physical risk? Are we potentially exposed to a carbon price if and when a carbon price is imposed, et cetera, et cetera. And so that's the type of reflection that we expect from the portfolio companies. We're not there to tell them what to do. They have management teams, most of the time, if not always, they're better placed to decide what to do themselves than we are, top down. But the idea is to force those conversations. And you see in the thing that I'm showing on the screen, there are 3 levels. So committed, aligning, and aligned. The big difference between the 3 is the ambition of the target. And we were very careful to have a graduated approach. At the committed level, so we expect companies to have good climate governance and a decarbonization strategy. Then you calculate their footprint and have it audited. They need to have a net zero ambition. But the most important part is they need to have intermediary targets. But here, we set the bar for bronze at they need to be targets, but they don't necessarily need to be aligned with science or with Paris. And the idea there is that, if I go back to my sports analogy, you're not going to get a gold medal usually out of the blue. You'll be bronze first, then you're going to improve. So companies that are starting on this journey, it is fair enough that they would set some targets that are ambitious, but not super ambitious, trying to see how it goes, and then up their ambition afterwards, or stop, in which case they would fall off the podium. There is also in a number of areas, such as cement, steel, it is not possible today to have gold. The supporting environment, the economic environment is not there. If you produce green cement, you will go bust because that cement is going to be a lot more expensive to produce. And therefore, we as an investor can't expect companies to do this. But a cement company that says, I'm going to reduce my footprint by 10, 15% by 2030 and invest a little bit to do that, that is what this bronze is about. And then the other 2, silver and gold. Gold is externally certified, aligned with Paris, so that may be an SBTi certification or an external certification of equivalent strength. And the silver is companies that have either self-certified their alignment in a credible fashion and are serious about it, or they've applied for SBTi. I think you might say that's very complicated, but if you are an investor with little means, you can put that in place in listed equities quite easily. The list of SBTi company is public, and so it's easy to just count how much you have invested, or if you invest directly, tell your investment teams, okay, well, this is something that you ought to be looking at. And for the committed level, we have identified indicators from service providers. And so we are now mapping the entire universe to identify which companies are bronze. And again, the universe is mapped. We know who is gold. We know who is bronze. And the question to the investment teams is, can you try to maximize this? But we don't tell them to. The risk return is the key here. But within their view of the world and how they manage their various portfolio, can you please take this on board and see what happens? And I think that approach has been working because, and I'll share my screen again. if you look at this graph that you saw earlier, this piece is SBTI companies. So is this and that. And in our previous strategy, it wasn't even a requirement. But investment teams actually at the end of last year had $94 billion of SBTI companies because of the climate maturity, because those companies tend to be better managed, maybe in sectors that the investment team favored. And so that is quite, you don't have to be a CDPQ with large teams, etc., to be able to do this. It is doable in listed equities quite and relatively automatically.
So given all that, I assume, given probably the sheer breadth of your portfolio, that you have sought and continue to seek credible climate action plans from your investee companies, and some are achieving and some maybe are not. So I'm curious to know, do you have explicit criteria for exit? So where you're not seeing change, whether it's you talked about your exit from oil, um, and that may be, a specific set of criteria there. But beyond that, for the companies you're still in, what does exit look like, or is that even a factor in your decision making? If you're
Well,
looking for ambition.
it may or it may not, but it would certainly fall off the podium. So if a company is not delivering on its targets and or has just set targets but are not credible, they would not be recognized in climate action. That doesn't mean we're going to sell them. It just means that they will not be counted as part of the 400 billion.
I see.
And now, I didn't mention that earlier, but all this is linked to remuneration. So there is a financial incentive for everybody at CDPQ to try to reach that 400 billion. So obviously, it will be taken into account by the investment teams. But the 400 billion is a large number, but it's not the entirety of the portfolio in 2030. And so there is still room for companies that don't meet the criteria.
That's very helpful. Thank you. So I'm sure folks on this call are still asking themselves, and we've talked a little bit about this, but I want to elaborate, if we can, about how any of this might apply to their reality if they're a small investor. And you talked about one of those being listings and indexes and thinking differently about public equities. That being one option, but I'm wondering if there are any other pieces. Let's say you woke up tomorrow and suddenly you were the CIO of a university endowment, and your scale had just shrunk dramatically, but you have no less ambition around climate. What would you suggest the first two, three, four steps should be in today's environment, no pun intended, to reach the level of ambition or approach the level of ambition you're talking about here?
I'd say first do a état des lieux, like see where you are. Try to map your portfolio to see what's in there. Talk to external managers, come up with a framework and talk to external managers about trying to shift or how they perceive the question. There's a very important aspect also is the indices that you may or may not use, because a lot of indices represent the economy of today. And you cannot be investing in something that looks like the future by looking at something that looks like the industry of today or the economy of today, or at least not even the economy, sorry, the stock market of today. And so that is something that one needs to think through very, very, very carefully, because the normal indices will not allow you to do this at scale. It will not allow you to invest in green. So one needs to think very carefully. There are green indices that are available commercially, but they're not all equal. A lot of them just weigh carbon and reduce carbon. And we end up back in a scenario we were at, CDPQ was in, with our first strategy, it was decarbonizing the portfolio, not decarbonizing companies. There are indices now that are smarter, that are focusing on that, on this, or you can create your own. But the idea is you need to think a little bit more broadly with a bit of active risk here. I would say that for us, we are out of the oil sector. We looked at this sector in the past when we made that decision and realized that over 15 years before we made the decision, so before 2021, the return on that sector was about 15%. No, 7%, sorry. 7% over 15 years. And we felt that this did not pay for the risk. We measure the risk with a VAR, market VAR. It's a risky sector, a volatile sector, and earning 7% on this was insufficient. And so we deployed the money in a different form of energy, so gone from fossil energy to the energy of the future, which is green electricity and decarbonizing things. And we made 50% more money. So that's the type of thinking that you need to do, and obviously convince your constituents that it is an important thing to do. Now, we still use those indices to measure performance, but we are convinced about this. And so we expect over the long term, now we're going to beat the normal indices because we are aligning our things to the future, to things that over the long term should be performing better than the current economy.
Thanks. So I have one last question, and then I see that there are 2 questions in the chat, so we'll turn to those momentarily. But I wanted to ask you first, so you gave, I think, a fairly eloquent explanation earlier in a way about the difference between idiosyncratic risk and systemic risk, and the fact that the risk around us, climate change, continues to be a force and to worsen in severity, and will continue to impact our economy writ large and the economy upon which all of our returns are situated. And we know that the health of the overall economy is a major proportion, a majority proportion of the success of our returns in the first place. So given that, how does CDPQ see regulatory and policy advocacy in relation to your climate plan? And do you look, and so that's part 1 of the question. And part 2 is, do you look to your investee companies to be positive actors in addition to yourselves in real economy climate policy?
Real economy climate policy is important, and we try to push where we can. We try not to play politics because we're ourselves state-owned, so we need to be careful. But when it comes to climate disclosures, for example, we've been quite active and vocal. When it comes to certain policies that impact certain sectors, for example, we might also be involved because it's rather sectoral, but we won't make much comment at the national level about climate policy. We need to be careful about the risks. But when it comes to businesses that we invest in or overall, regulation of markets, we do get involved. Or if we're being asked by the government, obviously, but we're not going to appear to play politics by making unsolicited comments. The thing is, to us, it's inevitable that the debate is going to go back to being more stronger on climate, whether it's in the US or in Canada. In Europe, it's slowing down, but it's still much higher. In China, it is considerably, there's considerable momentum. The country has 50% of cars that are sold today, 50% are electric. It has put more green power on the grid than the rest of the world combined last year. So that is continuing. And to us, this is the direction of travel. Governments need to be to know this, and even in the U.S., there is for those, I don't know if you've looked at this recently, but you read the newspaper, Trump is killing renewables. Actually, AI is pushing renewables, and we have a number of renewable investments in the U.S. and there's still growth. And the reason is AI needs a lot of power. Building a gas-fired power plant takes years, and that's if you can get your hand on a turbine, which are in short supply. Building nuclear takes 10 years. Building renewable solar panels, 6 months. Wind farms, a year and a half. And so it is still happening, and there is still growth. So one needs to really think about these things. And our view is the whole debate, the whole question about carbon pricing, etc., is going to come back, and companies need to be prepared. And we're a long-term investor. We think we're a pension fund.
Right. Thank you. And that leads very well into our, actually, I thought we had 2 questions. We have a comment. So somebody, James Gordon, shared some information in the chat that some folks, or in the Q&A, that some folks might want to check out. A link to the World Meteorological Organization's latest report. But we'll go to the question in the Q&A, which is about AI. So curious to get Bertrand's thoughts on the AI superscalers CapEx boom and pension funds' rising allocation to AI data centers, which are gobbling up energy and water. You did talk a bit about the energy piece right there. But is the AI investment boom delaying the energy transition and creating a net increase in climate risk for institutional investors? That's the question.
Yeah, well, it's difficult to answer, but I'll give you there is a question. Obviously, if they all go around building gas-fired power plant or reactivating coal-fired plants, there will be an issue with the energy transition, yes. The good news is that coal plants today are still expensive, much more expensive than renewables or gas. And there's also a talk to reactivate gas peaker plants, which are extremely inefficient and therefore expensive. So the good news is there is the cost of that kind of power is high. And so, yes, you can do it. It will increase emissions. My guess is it will not be as bad as it looks at first glance, because renewables can be deployed faster and they don't have emissions, and the hyperscalers are concerned about their footprint. But yes, emissions will increase, but not as bad as it said. Now there's a whole question about, and this is my personal view, I guess my gray hair will betray this, this looks, feels, and smells like 1999 dot-com bubble. All this trillions of dollars of investment that is just being rolled out when the use case is not clear. We shall see.
Yes, we shall see. That's a great place perhaps to end if there are no other questions. I think that's the only one we have left in the Q&A, and I've asked all of mine. Thank you so much, Bertrand, for joining us today. We really appreciate your insights and your pragmatism combined with serious ambition. And we look forward to checking in with you perhaps in a few years' time to see how the rollout of the plan is going.
Well, thank you. Thank you for having me.
Thank you.
All the best to all of you. Please copy us.
Great. Thanks so much.
Take care.
Bye-bye.
Bye.